Hi there. It's showtime week, that's for sure. Let's hope this thing, the US election, gets put to bed very quickly without all the ramifications, drawn out arguments, etc. Vote fixing nonsense. Let's just hope we get a result and we can all move on because it's been a bit of a drag, hasn't it? So, who have we got with us today? Hopefully, you've all received the preview on my Discord. We've got this new way of distributing info for Riz and myself. You've got to sign up directly. There was an announcement on Sunday. So if you want to see anything that I send to @Planty, my daily meme and the preview, etc., anything really important, then I'll be sending it to @Planty, and you only receive it or notification of it if you have signed up. So please do. Otherwise, just go onto my chat as you normally do, and it'll be there anyway. So I'll go through the preview and things to expect from this week and a review of some of the more important things from last week. But obviously, it's all about, it looks like it's all about tomorrow. It's become a bit of a coin toss, and that does cause issues for risk managers, just like we tried to teach you. It's all about having an edge. 50-50 is a random walk, and it's down to the laws of chance. We're just trying to get ourselves as good an edge as we possibly can, and risk managers are the same, which probably explains a lot of the reason why it feels a little bit less engaged out there at the moment, because it's quite a binary outcome other than money supply going up, whoever wins. It's complete polar opposites. So it is a kind of a proper choice over in the States, and that has ramifications for investment policies. It actually hurts other parts of the world a little bit more. There's a chart in this week's preview that I saw just taking you through the European tariff losers, which isn't a very pretty performance there, underperforming 20 or 30%. So there'll be a lot of very interested European watchers as things unfold tomorrow. We'll have a run through earnings season. I've got a great website for you to use that keeps you up to date with US earnings. And that's actually been coming through a lot better than the mainstream media are trying to portray it. And I'd admit myself, trying to follow and keep you updated through earnings season in the preview is quite onerous. There's lots of companies to look at. And there is a sense of lots of big misses when you go through the ones that flash up on the media screens, etc. But underneath, things have actually improved a lot more from certainly where we went in at the start of October. And actually, we're back to levels that the market was looking for at the start of the year and through the middle. But I'll show you how you see that a little bit later. And a lot of this is, you've got to remember, a lot of people on the sidelines, seasonality effects for stock markets and for the dollar. People wait to see what happens in the election year, and then once they know what they're dealing with, then they'll invest. So I don't think it necessarily means that it's coming off if either of them win over the other. It's just the magnitude of the effect. We've shown before, it tends to rally hard with a hybrid, actually, so you pop up there, with the Republicans, and it carries on pushing on in the following year, the first year, but not as much as if Democrats win, because they sell lots of fluffy hope stories that don't necessarily come through, but the market gives them the benefit of the doubt up front. So we'll see how that plays out, and it might just be that the Trump trade drifting off a little bit has just guaranteed that we have the end of year rally, or certainly the November seasonality, to come in. I think in the last 10 years, so I'm just being chatted to, I think. Somebody that just won't take no for an answer. Where was it? You tend to get the end of year seasonality in the stock market. We've gone through that before. There's also some seasonality in the dollar and euro that we need to look at. Blah, blah, blah. But let's dive into it. So the first line I've got there on the preview page is, remember James Carville. I've gone about him all the time, but he was the advisor to Clinton in the 90s. The guy who famously said he'd want to come back as the bond market could intimidate everyone. And that's certainly what's been going on at the moment. The bond sulk, as I keep describing it, that's what's causing us lots of angst. As you can see, 10-year yields since the start of October, they've been on this absolute march up, haven't they? From being down here 3.6 up to 4.3%, nearly 4.4. Remember last year, last year we had that push out to 5% in October, but then that pulling back massively kickstarted the rally in the end of 23 into 24. Will we get a similar thing now? Unfortunately, the worries for the market, or that the data has been improving, and we'll see that on the City Economic Surprise Index. It's been, ever since the Fed decided at Jackson Hole to go 50, it has gone nothing but upside on that surprise index until last week, really. There's a little bit of a turnover, which it looked like it was going to actually bring these yields off on Friday, but then we got that Friday afternoon recovery bounce, which is kind of telling you people are ignoring both the Fed and the data at the moment. The concern is the money supply angle of the election, and everybody is quite rightly concerned about that. So until we get clarity on who's going to be controlling the houses, never mind the presidency, it's likely to stay in a bit of a bid situation. It's hugging this channel that we've put in there quite hard, isn't it? So that's the situation. You had non-farm payrolls, worst figure since 2020, just stayed up, mainly due to government workers only. A theme that we've been talking about that can't carry on. That's definitely a sign that things will slow down quickly. I first of all tried to attribute the little spike in bond yields down to ISM prices paid, because that did look like it had a big jump, but there is a technical in that. I put it onto the chat for you on Friday, that it was literally prices paid were down the previous month. The unchanged prices month to month, really high percentages, around 70%. So you're just dealing with the differential between the ups and downs. And this month it was 20%. People had seen it up, 10% prices down month on month. So it's kind of 50% plus half the difference, which is around 55. The previous month it was a negative 1.7, so it was a contracting number. But the net to me, that tells you the majority of people aren't seeing prices push up. And they're only really in sectors that were being troubled by energy prices, whether it's either intensive for making things or for transportation. So that isn't necessarily a big inflationary print, because we know oil's being driven by geopolitics at the moment rather than demand pull. So keep that at the back of your mind. It's always a concern. And oil going up does have a big correlation with dollar strength, mainly because it's mainly paid for in dollars. Yes, I know that the Arabs have dropped the petrodollar, but in the short term, the majority is still paying in dollars. But net, it all comes back to James Carville. Until the bond market lets us, there's going to be this overhang of a yield worry that might just hold things back. It's not a problem for equities, particularly at the moment, but as we know, once it gets towards 5%, people start to take money off the table in equities. So it's something we need to keep an eye on. So yeah, let's just dive into something I was looking at earlier. If I can find it. Actually, I'll close it down. I'll go into the earnings now. So there's this fantastic page that you can find. If you can see the web page there, I'm not sure. It's basically Lipper Alpha, and they do this fact set all on the LSEG site, they literally do a review of the earnings day by day as we go through it, show you the sectors, the earnings rates, where it was predicted to be over previous quarters, etc., etc. So I'm going to put that into the fundamental analysis page. Let me just go back to show you where we find it. There's a website on the live chat. So they do this dashboard updated on a daily basis. So this was Friday's update, so included the last of the Mag 5, etc. So key things is that these are quarterly figures. So in Q3 24 calendar earnings season, and that could be Q1, 2, 3, or 4 for any particular company, but overall we call it the third quarter earnings because that's what we're looking at. Growing at 8.4% year on year. Now, if you remember the other week, I told you we'd seen downgraded amount estimates anywhere between 3 and 5% for Q3. And this chart here, Exhibit 3, blended reported and estimated earnings growth. For Q3, obviously, last year, things just going nuts. Thought they were estimating to be 13% in a year's time. But January, once we got into this year, and remember we had a lot of rate cycle ups and downs, didn't we, into the start of the year. So that's what dragged everything down because we weren't getting the rate cuts. 8.4% was the prediction in January, which stayed more or less up through the summer until we came into earnings season. We had this little panic that things weren't running full octane, etc., and it was downgraded to what to me here is the top of the range that I'd seen, 5.3%. Now, as of the Thursday update, which included Wednesday nights, so that was Meta and Microsoft, wasn't it? It was running at around 7.3%. So Thursday was an absolutely massive day, and in fact, that day year on year, it was running at just about 10%, 9.8%. So that dragged up the whole average to 8.4% earnings. So massively back on track, exactly where it was. Anyone that's telling you that earnings is a miss is misleading you. 77% I've actually seen a beat, which is around the long-term averages. Now, and also within this, the reason why it's not even higher and running at that 13% is down to one sector alone. Try and see where that is. Yeah, here in that blended report, energy is running at minus 27%. So they've had a lot of structural issues, and they've had the supply constraints, and then oversupply and various issues in each part, different sectors of energy, lots of Ukraine linkages, and then we've had the Houthis in the Red Sea, etc. So there's been lots of issues for that sector's profitability, and that is causing a real drag. So it should be running at 11.2% if you took that, if that just was at zero. So it just shows you the big effect that can happen. As it is, I think we're in a good position. So this is sequentially great going forward. Q3 here is the lowest predicted earnings input for the next 6 quarters, and it's now coming back in at the higher end of the range. So to me, I keep saying about it, growth trumps everything. Then here we have it literally in black and white, that the underlying growth is okay. Revenues themselves, they're running at 60-40 beats. You know, potentially some people read that as a slowing down of trend, but it doesn't look like that's coming through in the numbers. And then there's loads of other pages in this. You can see there's 11 pages. As you go down, it gives you breakdowns by sector and estimates by quarter and how they have changed. Now, one thing that I was listening to on Bloomberg last week, I can't remember who it was now, a large institute, but it's mentioned in the preview. They're saying that the market got a bit lazy, a bit complacent. They should have put through a few small downgrades in mid-year, so that Q3 was on an upward projectile, but that hasn't really happened. And she had the sense that these were beginning to be factored in during this Q3 season we're going through. So what's happening here is, up to date, we are actually coming in as a beat, and those downgrades that came through in October aren't manifesting. Whereas what people are doing is, for the next quarters, Q4 this year, Q1 25, they're putting through small downgrades. So October sequentially down 14, now to 13.1 for Q1 25. Q4 it's come down by 1%. But the way to read that, to me, this is stuff that all the savvy investors use. That, to me, that's in the market. We've priced in this slight slowdown, and yet even as we go through Q3 earnings season, the anticipated slowdown is not there. So that will be at the back of people's minds that, you know, there's another lower bar being put into Q4, and that's where I think we are with the Mag 5 from last week. I think they were good updates. There's a little bit of slowdown for some. It was a bit of a draw, wasn't it? We've had Tesla, Amazon and Alphabet doing well, Meta, Microsoft, Apple, all being caught up in this delivery timings and growth rates, but they're all massive numbers. To me, the fact that you've got Apple delivering 10 billion revenue from AI now on a quarterly spend of about 14 billion is just showing you how gangbusters it's going. I think they've created a low bar for Q4, which will probably either be beaten or will set us up for, if that's only in line, that is the sector and period to start worrying about the market. If we don't beat a lower bar in Q4 and we're going into a fiscally tough year, one where we've got all this argument about the money supply, auctions for bonds, overspending, you know, getting past the debt ceiling, blah, 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 then the market could have a bit of trouble at the start of 25, which is in line with the charts that we've been talking about. The 345 is supposed to top out for a high degree level wave 3 at the end of this year and then give us a difficult start to 2025. Anyway, that's enough on that earnings picture. Have a look at that website. Have it in your favourites. Good one to go to during earnings season. They've got lots of other clever articles just to help you look at how to value indices from bottom up. As like I said, risk managers don't really like a coin toss. We're looking to find things that will help us either way. So let's have a quick look into the weekly preview. Another bumper edition of 96 pages of my own charts, some charts that I think are worth looking at that other people have produced. You see most of them on my LinkedIn page. The people I'm following, there's some really good information given to the market on there. And then also, as usual, we've got last week's data in review, loads and loads of earnings this week, because obviously 37 to 40% of the whole US market reported last week. It was a right pain going through it for you, but there's some interesting bottom-up nuance from some stocks that it's just worth having in the back of your mind. So, you know, like I keep saying it, Drew mentioned it on that conference, keep referencing him. Like today was a classic. You got this oil blip in the air, and that was guaranteeing that the FTSE was going to have a very strong start today because the oil majors are the heaviest weights in that index. So if you have the micro at the back of your mind and you get a feel for how the macro or the index levels are going to perform, gives you a head start. So yes, we'll have a look at the bonds rates and volatility. October is supposed to be one of the worst. As we said, there's been a lot of buying of the VIX in anticipation of that 30 days into this election week, just full of super events. So far, we've gone through lots of them, BRICS, etc. Even the earnings season's not been too bad, as we've shown. It's more the flip-flopping of the split of the houses, the clean sweeps. Is Trump getting in or not, etc., etc., and then the geopolitics up and down with Iran and Israel, and how that has come through. And then, like I said, economic surprise. We'll look at that index, and then I will take us onto a page again today, and it's going to be the subject of one of the videos on aggregate demand that we started. The Atlanta GDP now, that is a roadmap for how you should be looking at the markets in terms of economics and macro, and you see it in real time. And last week was a perfect example of how that actually plays out in real time. You had the actual GDP come through, you had the crossover into Q4 for the Atlanta GDP, and then we saw exactly how what looks like it's running at 3.4% is suddenly 2.3 out of nowhere. And like I said, that's an indicator of economic surprise in itself, or you can try and find reference to the ones that the large investment banks produce. Citi and Merrill's are two of the most followed. We talked about, we'll get through that. We've got 4 investment banks, central banks this week: Royal Bank of Australia, Sweden, UK, and Fed, with the latter 2 expected to cut. The ones that we're interested in, really. Where's that gone? So I mentioned last week, and everything still can happen. And this is the first chart I'd found of anyone actually talk about it, which was Bank of America, the sweep, the taking the houses. Now, obviously, gridlock is the favoured outcome for people who play indices, because that generally means they can't fiddle around with policy too much, and markets tend to outperform when the US has a split House of Congress with one, House of Representatives with another. And this has been playing out for a while, and it's started to unwind late last week and into today. Trump, with a split Congress, or Trump sweep even being super high, 33% chance on the 17th of October. Harris in a split Congress, 22%. But the Harris sweep, I was saying I've not heard anyone talk about it, but that was in there in the mid-October, priced at 11%. What it does show you is that something that is it factored in or not? 44% chance of either candidate having the full sweep. So having gone from at the start of this campaigning looking very much like it was nailed on to be whoever won would have a gridlocked presidency. There's nearly a coin toss, not quite, but 44% back then, a couple of weeks ago, was pretty high, and that is what's causing a lot of the angst in the market, a lot of the consolidation, the sideways movements, not really breaking out to new highs, dollar remaining strong, etc. There's an outsized chance of there being the potential for radical economics. That is what concerns investors. They want a nice, controllable, non-volatile environment. So I keep an eye on how that percentage is looking over the next day. But if anything, it's a watch only, or look for extreme movements to trade against. So you're probably going to have a lot of intraday volatility. That VIX is priced high. We'll look at that. But the forward curve, the VIX is set to fall off pretty quickly after this week. So we'd expect to see that's another thing that can support risk on assets, or risk on in equities, if the VIX is falling next week and we have some clarity. Obviously, China are into a November 4th to 8th conference, all about stimulus, really. The market's looking for at least 1 trillion yuan, which is $140 billion, or in terms of debt bailout for the regional banks. Hopefully they will come up with a much bigger number for a debt swap, which again will allow some released equity, some released cash flow for not only the investors but for the consumer, and really look out for any headlines whatsoever on direct consumer stimulus. That is the next stage that the market wants, and that's what is really needed to get the full-on equity rally over there and for it to flow through to the rest of the world. Sorry, ASAP Rush, ASAP Rush. Thoughts on Bitcoin? Well, Bitcoin, again, it's been tied into the Trump trade, so you're showing a little bit of weakness. Generally, I think it's set up to break out with the liquidity offering that's coming up globally, the China stimulus, US Fed. We'll find out what's going to happen with the fiscal side of things, but again, that's unlikely to improve. So that's Bitcoin supportive because of the de-dollarization. We're due the breakout. It's been held, but we've been held back a lot post-halving because of the just the nuance on where the power pricing was, and a lot of the miners were having to sell their hodl accounts to stay alive. And a lot of them were getting bought out. There was forced selling from confiscated coins from a lot of the federal governments, Germany, and I think the US was selling. So there was a lot of headwinds that are out of the way. And if you follow Raoul Paul, GMI guy, who's massive, he talks about his banana money. They have a liquidity index that they've had for years that they use for risk on, risk off, and he's been talking about it for ages, the banana moment. That's kind of, I think it's a 10-week lag for the Bitcoin price. Well, the liquidity index has broken out massively, so you'd expect, I'd expect a Bitcoin breakout to come, and obviously if Trump wins, then he's mega positive on it, and Mr. Dogecoin, Robo Doge, Musk is all over it with self-interest, so that will obviously follow through there. So that's my idea. I think Bitcoin, obviously, there's going to be some nervousness whenever we don't know the result. You might get a cheap in if you're lucky, but net, I think the chance of a big breakout versus big sell-off is biased to the upside. And again, there's been a higher correlation of late as it's gone into the mainstream of investments, the ETFs, etc., with equities. So if we do get the equity rally from here, certainly into the end of November, possibly into the end of the year, then that will get dragged along. So yeah, so China have got their eyes on it, and that's why it's November the 4th to the 8th. They need to see who's won that election or have a good chance, because if Trump wins, tariffs are going to hurt their companies, it's going to hurt the consumer for jobs, etc. So they may have to come out and do their bazooka on the domestic side early. So the end of this week could be massive. We've also got Nvidia joining the Dow on the 8th as well. On the 7th, we've got the Bank of England and Fed decisions. So it's all there, as I described today, massive. It's all massive. It's no more massive than Sheffield Wednesday getting hammered on Sunday as well. If you remember that. So Intel's being replaced. Now, whether that's going to have much of an effect on the Dow, as people might anticipate, it's all about prices, remember, for the Dow. So being at 140-ish, it's big, but it's not the biggest. But that will potentially be the catalyst for helping see Nvidia grow quickly. And if their results come through positively, then you get this peculiar price shoving bias that goes on. Again, Berkshire Hathaway, did anyone think that he wouldn't continue selling Apple? We're sort of looking at this a quarter behind on the releases, and he's carried on selling it and going into cash. Kind of makes sense. Or Microsoft and Apple have got some tough chart patterns if you look at those. So they've got a lot of technicals to overcome in the short term. May well be that we get led by breadth again, and it's a kind of two-way pull within that tech sector for who the winners and losers with a net upward bias. It's got a little bit of detail in the preview on some of the tech earnings bottom-ups there. Remember, as we said, look at that chart I showed you on the earnings, how they started at the beginning of the year and then started to deteriorate. People last year were moaning that it was all capex, no return on investment. This year there's return on investment, but they're moaning it's not big enough or not quick enough. So it's always people wanting more and more, but all these guys keep reaching the bar and going beyond it. And net people are still going to deploy money. The Altina, there is no alternative. You can't really afford not to have some skin in the game. And it was an interesting point I heard on Friday. Big tech is political and macro agnostic, or it should be. They're not really bothered. They can't affect politics really. Although I did show you that chart last week, 6 out of 7 are massive Democrat donators, as opposed to Musk, who backs his own man. But really, it's been a hedge. Tech will benefit whoever wins. So it's been a kind of, you're in there because it shouldn't have much micro effect. It's kind of, it's a bit like a call option. The downside is slightly known, despite it looks like we're at all-time highs. Are we? And people keep saying we're overstretched on multiples. I keep showing it. We're only a third of the way there. As you can see, the big winner in terms of revenue growth in cloud was Amazon's AWS, the orange one. Microsoft just slipping back slightly, despite still hitting big numbers. And Alphabet, they are beginning to get the big hits. And as they said, they're getting an increase in subscribers and staying online longer, which increases their underlying model, never mind what's happening in the cloud space. So I'm always listening out for comments like this. Much of the adjustment in the market is the forward expectations, but there are a lot of reasons that the good earnings will continue. So infrastructure and AI stays there. The earnings are still growing. So the multiple should still hold up, really. As long as we're growing and we're beating, and we've just come in with that, as we've gone through earnings season, people will view that positively and be prepared to pay a higher premium for it. So to me, there's no reason why that's going to change in the short term. Like I said, there might be a bond wobble as we go into 25. That is the thing we're looking out for. Tesla, very interesting that their energy business is flying. So the cars and the robo-taxi is almost a sideshow still. He's all about the crypto side of things, the energy usage. He was talking about using the sun, wasn't he, at the weekend. Musk is back front and central and in the areas that are important. I've done a lot of work on data centers and electricity, and there's a market between crypto miners and data center usage where they are willing to pay. It's all about capacity. Who can create the capacity? And Tesla, by the look of it, are making great strides there. You've had the old Tesla wall and various other things going on there. And he's also trying to value his XAI business at $40 billion. Is coming to investors. So he is front and central in the right areas again. Will Tesla benefit on the back of that? So I was watching Rick Reeder on Friday. He's a top man at Bloomberg bond side. He thinks that they will deliver in November, December. I think that's the case. And while we're here, what's the first thing you do when you get up in the morning? What's the first page we go to? It should be this one. As you all have on bookmark now. Fed meeting tool, CME tool, all about Fed funds rates. As I got in the preview, that had gone down to 0 on Friday, popped up to 1.1 by the end of the day as that yield push came back. But we're back going into the meeting, 98%, 25, 1.7%, 50 bips, and 0 was dropped off completely. And where are we there? And it's 80 or 81% saying that there'll be another cut in December, and 18% saying stick with the one. That's quite bizarre that you've got 0.3% for no change on the December contract read through, but it's 0 on the November. That's an anomaly, I think. Boom, boom, boom. Or maybe there's just an open contract. Yeah, there must be some latent exposure that someone's just letting run off, which is keeping the percentage in there. But the true situation is that no one believes there's anything else. Actually, we just updated, didn't we? So rewind all that. So again, this shows you the volatility real time because that has flip-flopped from 0 1.1 to 0, and now back to 1 spot 8 again on the update that we just had at 10 to 1. Should have refreshed the page. Note to self, always refresh page. But yeah, it's minuscule and almost, to be honest, it's not happening. But that explains why there was something outstanding on the December contract as well. Right, there you go. But really talking about nominal yields, we talk about a lot. You can use that in estimate, take away the whole inflationary argument with the Fed funds rate should be around where nominal yields are. Rick Ryder thinks that they will fall back to where the 10-year is trading 4.25, 4.5 tops. And then that allows the Fed to cut their rates, certainly into that 3.5, sort of 4% rate. They'll want to keep it a kind of 1% tightened basis between the rates, but it all depends, as we said earlier, what is the situation with the houses. If they're split, fantastic, they can all move on. If it is the sweep, then everyone's going to have to readjust, and there will be the market will ask for payment for that to happen. But that was interesting, wasn't it, last week? The Musk's Doge agenda. It all sounds very funny, but if somehow they were to find 2 trillion of savings, then the whole discussion would massively change. Anyway, we've been talking about it for weeks, expecting that move index to break out and move on. It's sequentially been moving up. Market continuing to sulk, but have we just run into the end of that short term? We showed that the 10-year yield is up, extended within that channel 2 years, as you'll see in a minute. Have been following the 10-year yield, so we've had lots of volatility in the last few weeks, but there's every chance that starts to deteriorate again or slow down as the economic surprise index rolls off. VIX, meanwhile, over here hasn't broken the top of its 4 or 5 month range. We've been expecting it to drift off in the main. That is all protection buying again, the little blip up. As I said, if you look through speculator data within indices, then the hedges and speculators are really long underlying stocks. They're long underlying equity options. So that's all buying the upside, but they understand how volatile it potentially could be. So they've got downside index protection in there, taking away what they call the beta element, the market risk, so that they're only left with the upside alpha risk, the idiosyncratic stuff, the stuff that moves individual stocks. That's where you make the most money, and that is how they've got themselves positioned. So net sensible positioning, but would expect the cost and maybe the volume of those hedges to unwind in the next few weeks, in which case expect VIX to come down into that sub 18 region, and obviously that is when the big quant vol players absolutely love it. You get that vol anywhere near 1% a day, and it is full on risk on. You can see the same thing if we were really at extremes. The volatility of the VIX itself, the VVIX, would be at highs. It would be up here, as you can see, above 150, but it's not. It's in more or less where the mean is, in the 120s. Divide that by 16, and you're looking at 7 or 8% move per day in the VIX itself, which is anything between 1 to 2 points move, and that is how it has been moving. And then again, the ratio of VVIX over VIX, that should be fairly constant, but there are times occasionally when the volatility of the VIX goes up and the VIX goes down, and vice versa, which gives a range of pretty much 2 to 12, I think, on historics, and we're bang in the middle of that at 6 or 7. So even though the VIX looks elevated, we're right bang in the middle of where it should be on volatility basis. I know that sounds like a lot of gobbledygook, but yeah, the VIX of the VIX is where it should be. Just take it at that. It's not neither too fearful nor too greedy, and it's there for special reasons at the moment. There you go, just to prove where it was yesterday from Friday. It stayed there yesterday morning. So again, yeah, with big week for the Fed, they've got to get their messaging back on point. The bond market, with the yields going up, that's basically priced out a lot of rate cuts. There's 108 gone from 25. The average number of the aggregate to come off is now just around 1% by the end of next year. If anything, that's gone a little bit too extreme. Somewhere between the two is probably right, because we started from, where are we? We started 4. Say it's 5%. 4% is a reasonable target. They started at 4.5. To say that they're only going to get to 3.5 is, only going to get to 4.5 is a little bit too much of a sulk, I think. But obviously, that's only another 2 small cuts away. So what a lot of the bond vigilantes are saying is that they might be able to sneak through 25 and 25 for this year, but then next year is going to get very difficult. And that's where we might see the proper repricing come in, subject to money supply. Keep going on about it. We keep going around in circles, but everything comes back to the same thing. We need to see growth with spending reined in. Otherwise, remember Goldman Sachs had come out with that idea, lost decade. We showed how Ed Yardeni had poo-pooed that a little bit alongside Fidelity as well, Drury and Timmer. You'd have to have a massive crash to make that happen on an aggregate basis, purely because of the share buybacks and dividends. So ignore people just looking for headlines because markets are at highs. Hi, Andre. How are we, sir? How's Romania? How's the beer? Trump to win tomorrow. I mean, anybody could win. They're all within the tolerances of statistical error. Some opinion polls are driven by betting amounts. It all really depends on turnout. For once, you might have an election that does see a big turnout. I think the lower the turnout, more chance it is for Harris, isn't it? Perception is lots of women have voted early in postal ballots. So it is a coin toss. Any of the outcomes, literally, in my mind, are still possible. And we almost don't want it to be too close, because then if Trump loses, it's just going to drag on and on and on. We just want some form of clarity and acceptance. So in which case, I think the setup is that we can go back to seeing indices, investors come in. There's every background drop for it. Obviously, we might get a re-rally in gold if Trump wins. Trump trade comes back on. Certainly don't underinvest in tech if Trump wins. That's set up to be breakout. As we said, Bitcoin is a big winner of Trump. And Harris overall, as long as she doesn't get that sweep we were talking about, even though the biggest criticism of the Democrats is not actually implementing enough policy, having the opportunity to do so brings in a risk premium. I agree. If Trump wins, I think crypto is strong. I mean, my own opinion from a note that I did was that Van Eck, I think, had $1.5 million by 2050. And I said that's not enough. Just based on the fundamentals, the compound aggregate return is a lot bigger than that if it just continues at the rate of price movement based on the halvings. And obviously we know it's a fixed system, it's a closed loop system. And there's a lot of catch up in this present cycle because of those suppressing things that I talked about 5 or 7 minutes ago. Then it's due just a catch up breakout, never mind the fundamentals. We've had a mini trust moment, as they call it, post-Labour budget blues. quite rightly, I was surprised when I was listening to it. I thought, well, they haven't heard the rich enough. I heard the growth rates she said the OBR had come out with. I thought, well, they don't sound any better than what the Tories had. And in fact, in some cases, probably a little bit lower. Now, the UK is already the poster child of Europe because Europe doesn't grow and we're just growing. But nobody likes the fact that they've added to the tax burden, the spend burden, and making it difficult for companies at large. Anyone that does have a workforce of over 10 people are being hit on minimum wages and national insurance. So there needs to be some allowances brought in on the other side to encourage investment and growth. Otherwise, you're going to have things grinding to a halt. And I'm not quite sure how that all sits with dragging in overseas companies. Overseas investment isn't going to be your 5 to 10 person little business. They're supposedly looking to get large cap investment in. So the bond market started to sulk a little bit, quite rightly, and it's given them their first test really of how they deal with that. They need to get some cast iron guarantees from the public sector, civil service, that cost cuts and efficiencies are going to be made. They need to get some of that money back. And that's being politically agnostic, no political interest whatsoever. That's just plain hard economics. So a little bit of a rally in gilts today as people just looked at the whole picture and gilts relative to the US, etc., etc. So there's been a small rally on, and there's been a positive environment to start the day in the UK. But that showed it. Reuters breaking views last week. Everything got up. Spending as share of GDP up, taxes as share of GDP up, and borrowing through the roof because she's changed the rules. Now, she did get advanced nod from the World Bank and IMF of what she was doing. Anybody could have done it. It's a bit of tinkering with the rules, but obviously it needs to produce and in a non-inflationary way. Otherwise, it won't look well. Hello, Vivi. I haven't seen you for a while. Hope you're well. I imagine gold is treating you well. Just to show you the extent of the sulk that upward trend channel is on the US 10-year. Just look at it in terms of modern day monetary easing cycles. The move we'd had after, 30 odd days, the first 50 days were on track after 30 to be the highest yield shift we've seen. Now, things could change post-election, and look, after the yield sulk generally tends to drift off after 35 days. They may get away with that, but there's every chance that still ends up being the highest sulk after 50 days, regardless. But that will be in line with the November end of year risk on surge. So there's the up channel we were talking about. And there's the fact that since the rate cut in September, 2-year and 10-year all been sulking. The inversions disappeared, but the absolute rates haven't, and that's what's caused these ups and downs here, is what caused the move index, the big V shape. Looking 30-day average over this period, it's very volatile. So we had the non-farm payrolls, as we said. It includes the 44 Boeing strikers. It includes a statement that it was affected by the hurricanes, but go through the data. That's how I would go through it. I saw someone else. This is someone else's picture. That's what I would have been highlighting as we did. Government, again, up 40,000. Average gain is 43,000 for government. We've been talking about that for months. Government's been holding it up. And now that private isn't there, and the fact that, remember last month we had that big seasonal adjustment, which we said was highly likely to cause revisions. I think we got non-farm payrolls right going in. It was priced for an upside beat, and yet I thought everything was suggesting that was going to, if that even happened, it was probably market impact was in line, and if anything, it was likely to miss, and we got there. There you have it in a bar graph from the BLS website. Figures But healthcare, just like last month, a lot of part-time, a lot of low-wage stuff, plus government, a little bit of noise around construction, probably hurricane rebuilds, but everything else is a little bit underwhelming. And I imagine that leisure and hospitality, that was the big mover the previous month. It was probably revised down. I haven't looked at the change in that month to month. We'll do that later. But manufacturing missed, personal provision and business services missed. That's not good. This bottom one is a worrying figure if that trend continues. That's the area, the high wages, high value added stuff that you want to see growing, that pushes GDP, which pushes company earnings. So we wouldn't want that trend to grow very much, and neither would the Fed. So that is the Fed looking at that in totality. They're worried about that, government, and they're very worried about that. So there will be rate cuts. As I said, I explained it earlier, but there it is in words, just how the diffusion index works on the ISM. And that isn't really an inflationary print on the prices paid when the majority, 80%, was no change or lower, etc., etc. Reshinu, I didn't realise that. What have you been doing? So you've lost all your accounts. So everybody, you've got to get on top of your psychology, walk away when it's going wrong, don't chase it. Ones and twos. That's right, Vivi. Stick to my guidance. Hey, we'll get you back, Reshinu. Keep your head up. You've done it before, you'll do it again. Just back to basics. And there's obviously a lot of suppressed markets at the moment, so just get ready for the breakouts. I don't know if I put it in this week's commentary anywhere, but I was reading, it's the top traders, it's as important not to trade as it is to trade. We're going about it all the time. It's the hardest thing to do, always wanting to be involved, but the bigger returns are made from waiting for the setup and then trying to maximize that rather than trying to create an opportunity. It is the hardest thing, sits on your hands. The not trading trade is possibly the most difficult one to learn. Again, a couple of trends within there. The total job openings, as we said, were trending down, the JOLTS index. And the ratio of JOLTS to the actual unemployment number is trending down as well. So only 1.1. So is that the case that jobs are disappearing for a market that is imploding on itself? Another way of looking at it is what David Rosenberg talked about, was the aggregate hours worked, which is coming out at a low number, which is suggesting that there is some worry, some trends underneath. We know people are taking more than one job. We know that their main jobs are now having fewer hours. That eventually manifests itself with job losses. At the moment, it's just been people seeing cutbacks. So that net for us, investing wise, that means that, read through all the noise, we should have supportive monetary policy in the background. There isn't any real return to broad-based inflation in the Fed's measures, at least in PCE. We know that it's stuck in motor parts, which have been easing a bit, motor insurance, car rentals, etc., etc. We've just started to see OER, the rent break. So if the rent breaks properly in the next couple of months, which it should do according to the lagging catch-ups, then there's every reason why into the end of the year the Fed can definitely signal in advance that they are happy to normalise. So a good point to use here. City Economic Surprise Index, which I talked about. So the Fed were here, Jackson Hole, and from the time they made their decision there that they were going to cut in September, all the data that's been out since, look, we talked about it before, but it's all been on this absolute tear up. Now, we've had a couple of pauses along the lines. We've just had another one. Is that going to be enough? Will that follow through, or is it just temporary blips? If we suddenly see that surprise index come back down to 20 and below, then it is all guns blazing. That's when you'll get that big yield shift down that we just showed on the chart above, etc. So we need to keep listening out. Anybody sees that chart, throw it onto my chat, make everybody aware. They update it weekly. And on that point, a way of following that is to look at the Atlanta GDP now. We go on about it, but that's real-time measuring of that aggregate demand. Basically, that's C plus I plus G plus X minus M that we've been going on about. You can see it real-time, and let's go and have a look at it and see how it's been moving. So you literally go to the Atlanta Fed page and you search for GDP now, or you follow the link. So there you have it. So once you click on that link, it will take you to a couple of things. And this shows you the range of forecasts in the market, and the blue line is where the Atlanta Fed would be. And then they do a daily update to what the GDP estimate is, and they release it after, well, not necessarily, well, they release it after the data point days, of which, where were we? Going into the end of Q3, and when they released real GDP last week, the government, the BEA, that came in at 2.8, and that is exactly where Atlanta GDP had said Q3 was, real time at that point. So then they went into Q4 as of the next day on the 31st. Taking account of some of the elements of that GDP, they said we're running at 2.7, and then we've had ISM and construction data and then employment data. So we're now running down at 2.3, where if we go out of that, they do a real-time commentary. So they give you a commentary of why they've done it on a daily basis. So it takes you back. So going through October, and that come all the way up to 3.2 by the 9th, 3.3 by the 25th. And that had been due to the realtors, so that was housing data and real domestic investment growth spending, that was up. So that decreased, that taking it off from 3.4, and that's it. But they tell you why and which components are doing it. And then we ended up going down to 2.8, and that was due to the net imports or net exports, as it was the trade balance, X minus M, that the imports had grown and the exports had fallen. We expected that from looking at the ISM reports, that the new export orders had been a bit soft. So there was every chance that was going to come through at some point. So that's how we keep up to date. We look at each individual data point. We look for where it affects the model, and then you can anticipate what that's going to do to GDP, and then that is what people think about growth, and that all feeds through to earnings, and they start thinking about, are there any sectors that are dominating the market? So if we go back to that other page that shows you it by component, they show you the effects. So when all that labour data and the GDP data comes through, they have it split down. So if you're thinking that's C plus I plus G, X minus M, so that's X minus M there. And then you've got the change in net exports. And then you've got here change in private inventories. So that is when, I've mentioned it before, sometimes there is a measure in ISM, it tells you whether inventories are things being made but not being sold, or whether people are buying or are actually making stuff to meet demand. So when that is positive, that means that the economy is just building, the inventories are going up. And when it's got a negative effect, that shows you when you've got demand. So it's really important for having a feel underlying for whether the economy is slowing down or moving up. PCE, as we know, that's personal consumption expenditures. So within that model, that's the C. G is obviously here, government. That's X minus M. So all the others are to do with investment, really. So you've got equipment, intellectual property products, so it's patents and things. So literally within both of those is a high element of the whole tech, NVIDIA element. Then you've got non-residential construction, residential investment. So that's both sides of building, construction, and what you're looking for. And that one is building permits for residential investment, building approvals, new house builds, etc. So you start to get a feel for looking for when the data points come out, what are they actually meaning? What do they feed? So they're feeding this model that feeds GDP. This is from the demand side. And then they tell you what the conditions were like when it was intra-month, running at a high and low print. And then within it, it shows you, so you can have a feel for when you see the numbers, it tells you the contributions that those areas all make to GDP and how many percentage points up or down it actually is responsible for. So we are going to go through that as a separate video of how to read all those links, C plus I, Gs, etc. But hopefully that gives you a little taster of how real time it is just falling over again. The feeling, the anticipation you see a bad number it is, but that shows you in real time the kind of effect that it will have on GDP. Euro actually had a couple of surprises, and that may have a factor to play in the weeks ahead. So DXY, the dollar index, that is made up, 57% of it is euro dollar. Now, in the last 15 years, there's been a 93% occurrence of the euro bottoming in the middle of November, around the 12th, 13th. And the dollar equally of topping out. So it has strength generally into this period, and we've had strength due to some of the Trump factors as well. Keep saying that there is a seasonality ahead where we're likely to see, despite what all the fundamentals are telling us, that the dollar may well just be about to sell off, and the euro and probably sterling at the same time have a little bit of a bounce. The yen we've shown, and I'll show again, how it's close to a turn, and it's got potentially a rate hike baked in for December, January. It massively correlates with the US federal guidance. So Thursday is important for Japan, wherever the guidance is for rates will have a big effect on UJ. So we may well see a reiteration of the Fed's target for interest rates, in which case UJ could well be under pressure as a result of that. So we keep going about the nesting, the ones and twos in the dollar. Fully expect that to turn around, but there's a reason why the euro also short term may have a bounce. They don't have a meeting until December. The data surprised on GDP last week. Germany finally has had a couple of reports, GDP and PMI slightly ahead, and also sticky CPI has just come in slightly above. The core CPI 2.7, the headline was around the 2% target, but lots of commentary from the talking heads in Europe about this sticky inflation. Might just be enough to get the bid back into the euro before they potentially cut again in December. And I mentioned that again, there's a lot of components, particularly in the DAX, that have been the wrong side of this Trump tariff trade. So S&P 500, big outperformer on the year. Euro stocks up 8%, but down 11% is the US tariff exposed European companies. So a massive 20 to 30% 20 to 35% underperformance purely because of the threat of the Trump trade. So this would be a basket of stocks to get involved in if Trump doesn't win. That would catch up massively. But it's also been having an influence, downward pressure overall on some of the European indices. We're talking about seasonality, keep going on about the seasonality of equity markets and particularly in presidential years. Look, we had a bigger sell-off than normal in this presidential year for the August carry trade, July, August, but we caught that up pretty quickly. It's still below the composite line. The red line is the actual line where we are. The blue line is the normal trend. And I was saying last week, should we be taking profits because we've had a bounce back, when if we are on trend with what normally happens through the cycle in a fourth year of a presidential cycle as well, then look, the massive part of outperformance is yet to come in a two-tier. Big rally into the November, consolidation, and then another move. So should you really be, you should be closing your eyes and buying it, not actually running away. I mean, obviously at any point, these things don't have to be correlated, but blimey, that's pretty strong correlation as far as I can see. Sell at your peril is what I suggest. Arguments against that, obviously, Bank of America, they are trying to make headlines. 19 of 20 metrics they look at, and this is historically for the last 40 years plus, are all quite above their average levels. This is in terms of P's and Schiller P's, you name it. If you want to find a reason to sell, you can find it. But as I just showed, you're fighting seasonality and the strength. What is the end goal of trading for me now? Well, still securing my future. There's always plans. There's always things to pay off. School fees, university fees for daughters, helping them actually live somewhere. Just winning. I've got a lot of my money tied up for the next couple of years, so I'm just making sure that I get that over the line. And you know, people are living longer and longer, aren't they? So I'm only nearly 53. I anticipate another 30 or 40 years, strong as an ox. So I need to pay for that. So that is obviously a goal. I like trading. I love being involved in it as well. It's like intellectual chess, isn't it? It's brilliant. So I've always found macroeconomics fascinating. So I love to try and keep my hand in. Yeah, net, I'm competitive, so I like playing the best game in town. Equally, how do you view the conference board consumer expectations of 12 months for stock prices? That's at one of the highest levels it's been in the last 40 years. Are they wrong? Are they right? I mean, the conference board is the figure to follow on job prospects, where they say that jobs to find are easier than hard to get. Historically, that's been the best correlation of the unemployment numbers, which is one reason not to panic about recession. Things are softening, but still okay, according to the conference board. It's one of the better answered surveys. So that's definitely a true reflection of what people think. Are they over exuberant? That's a different angle, but they're able to see the information. They can see the earnings season. They can see what's happening with the big tech, and they can see what happens in fourth years of presidential cycles. They go boom, and they go boom at the end of the year anyway. Until they don't, obviously there's always statistical anomalies, but I think with this one you play it until you see evidence that it's not. We went through the whole earnings thing, but that is a brilliant site that I put above that. Lipper Alpha, make sure you use their content, absolutely brilliant. So I said 4 ways that the dollar may go down. And that was up to yesterday. It did open down. The option was that we may have put in the three-way move short term up to there. So that really, I should have put 2 as a question mark there as well for the sell-off. And we have actually opened today. We'll look at that chart up to date in a minute. But the net is that dollar seasonality we're about to play, that's the reason I originally thought we might do a double extension. It may well be that this has just morphed into a bigger wave 1 and we still consolidate up to that. But some degree it might not get as high as that 104.30 level again. But the seasonality from next week is down again. Not guaranteed, but I'm having that as my in the background. And that just sits with UJ, as I said, that's extending. We've been talking about, is that small breakout there, the wave 5, or is this just another sideways consolidation which has one more high? Either way, I wouldn't expect it to get much higher than 154. And if anything, I feel like you want to be having that with a higher stop loss, probably a 155 stop loss. And selling UJ would be my thoughts for the next few weeks. EU, again, you've got, where the eventual low was. It does look like it's put in 5 waves that were consolidating. And again, just like the dollar, that's probably moved again today. Wouldn't rule out, again, that being an extended one. Still get the 2. There is, by definition, a third wave coming, and that's what we're looking for. So that's why I keep saying the bias on the euro, and again, with that seasonality, is set up for some time during this week or into early next week to have a proper breakout. UK again, see how much commentary Catherine Mann can get into the Bank of England's prognosis on Thursday. She's intent that she's not going to vote. We know there's at least one person not voting for a cut. She said she doesn't care. She sees things that other people don't. Hopefully it's the door. Then indices, you talked about all the sort of things that have happened. Is the Trump trade, is it not happening, or do we? Instability, again, depends on how long it takes to get clarity. I think if we've got this hung vote, if it drags on to December, like Bush Juniors did, then disaster time, that could cause a much more choppy sideways move with a few lurches down. That may even make us do the wave 3 topping out a little bit earlier, and we're into a deeper consolidation. But that's the least likely for me at the moment. But it's got a higher probability with me than it would normally. So probably got to say there's a 25% chance at the minute of this being so close that it drags on, which is why we're seeing a lot of the nervousness. Outside that, I think the pullback is the Trump unwind short term. Now, we've said before, it doesn't matter who wins. This, to me, is baking in outperformance once we get that clarity, because the guaranteed Trump trade has unwound a little bit. So that's left us a little bit more on the side for Republican outperformance. And obviously, we know Democrats tend to get rewarded when they sneak in. Last week ended 29 sessions in a row without a 1% down day, Thursday night's performance. But as I said, earnings growth is already running. I said it was 10% when I wrote that, and it's now at 11% if you take energy away. We know NASDAQ has been under pressure with the heavyweights. That's all that's talking about. Onto those usual charts. Again, the key thing to look at for the S&P is that a lot of the fluff has gotten out of it. The puff, less than 50% stocks are above their 50-day moving average now. It was 45% at the weekend. The 200-day continues to slip back. And we've already done what looks like a 2 down legs, 3-wave consolidation to touch the 50-day moving average. We're testing that. Currently, we are going to flip-flop around that tends to regain it in the current way things have been going. Now, by definition, we're very close to overlapping wave 1, wave 4. That doesn't matter. We're in a wave 5 of 5 coming here. It's an ending diagonal. It's been showing that for some time. It's not a case of, will it just keep going in a straight line? We are due to get to this 5th wave here towards the end of the year, and I'm anticipating a sell-off. So that is by definition going to be an ending diagonal. A lot of the mega bears have already called that as being that wave 3 I've got there, low degree, as being the top. I just think they're fighting seasonality, fighting positive earnings, and I just keep going about the same trend. It's the fighting trends. We've already made room. People are talking about the things about to crash. I think we've already had the consolidation. It may rally and just double that, just to have a little test of in between the two moving averages, but doesn't have to. Again, this is back down on the equal weight. So we look for breadth on the way up. We also look for breadth on the way down. So it's not just the tech stocks bringing the S&P down. It was broad-based selling. The equal weight index has also done a 3-wave, equal legs, pullback and testing its 50-day moving average. That to me is quite positive. We've lost momentum, blah, blah, blah. That sounds bizarre. We've lost momentum is a positive. We've already built in that loss of momentum into a classic consolidation. This is kind of building up to, this is all just building up for that breakout. Dow's got Nvidia coming in, but at 140, its price changes. It will need to see lots of 5 and 10% days, which we know Nvidia can do, or sequences in a week, to have big effects because it's based on the actual price. But it's in the upper half of the prices. That happens on Friday. Nasdaq said the same. Now that obviously is getting quite close to a bigger sell-off. If we don't have to have it in the back of our minds, if it breaks that 2 level, then I think what we're seeing here is a wider consolidation. It is nesting at the moment until that 19,600 gives way, which is only a couple of percent away. Then we're still in the near-term nesting breakout. If not, there is a lot of room to play with in here since the August pullback for that just to be an extended consolidation. It's been choppy enough to suggest that you can't rule that out. I've got this label as a wave 1 again, as a leading overlapping diagonal, as a wave 1 of 5. But often those things always have in the back of my mind that could just be part of a bigger consolidation, because we've had it's what happened with the DEX. We were sticking with 1s and 2s for ages, when actually in the end it ended up coming down here and having done a flat and then zoomed up out of the way. Either way, the setups remain bullish. I don't see the market being much more than a 10% pullback at any point, really, and that includes when we get up to the ultimate wave 1. So we're in an area right now where if you buy, you should still be okay, even if you miss. So even if you don't buy now and it goes to the highs, you should get a chance sometime next year at the same level. Equally, that can work. Say if you've got the big enough pockets, you could sell. But I wouldn't really want to be selling a 3-month 10% plus rally just to end up back there in 3 months' time. That's a waste of time. So I'll be looking at, well, personally, I've bought a little tranche here. I'll be looking to buy a little bit more if it comes down here. My primary view is that we hold this too low for the minute, but the extended volatility that we're expecting from the VIX, etc., we could intraday break that around the election on news flow tomorrow, in which case it's just an extended consolidation. We'll move the 2 across, ready for that breakout wave. I don't think that technical picture, even if it short-term breaks down, changes anything. So what's the net of that? You need to be nimble. You need to be looking for pullbacks. You should expect the tech pullbacks to be more volatile than the other indices, just by the definition of how they move. So don't just dive in on points. Keep an eye on the percentages. And even the mega bears that I've been reading out there on the Elliott charts, they acknowledge that if that high that we put in last week, so the intraday, the actual closing high, not intraday high, because that is the top of the primary wave 3 over here. If that goes, then we are in breakout all-time high top time, so the mega bears, the ones that are expecting the mother of all sell-offs in the short term, still admit that it's a two-way pull because they know that seasonality is against them. These guys will find any way of spinning it. So the Nikkei, again, I feel like it's meandering towards a leading diagonal 1, but that could also have happened here where the wave 3 is. So this could already be consolidating, ready for a carry trade push, maybe. But no, if anything, I'm anticipating more carry trade unwind, or certainly yen strength. So that may well be that it's going to put in this double extension short term, and then it rallies. It's going to be very choppy, meandering by definition at the moment. Japan, as it's fighting with mixed fundamentals, and as I said, it's really dependent on the Fed's path just as much as its own data. DEX showing its resilience. There's talk of them trying to partner up with India more because the China reliance has blown up in their face. As I said, they should benefit from a Harris win and a tariff basket unwind. If not, then the short-term DAX may be a bit choppy, a bit more lower consolidation perhaps before it finally breaks out. It's just beginning to get back positive momentum. UK, that was interesting that it bounced today. I'm not sure that that's anything more than just choppers in here. There's still that equal legs pullback 78 to 7,900, break of 8,000, just still annoyingly in the background. It almost feels like there's a mistake from someone somewhere in the FTSE before it will finally make that breakout push for the end of the year, but it doesn't have to. It's hit a 61.8 fib pullback. I'm happy to have that as a short-term stop loss, just with the idea that if we get stopped out, we're looking to get back in a couple of percent lower, really. Don't have to carry it down all the way. But again, just be careful of selling any of this because it does benefit from oil. It benefits from strong dollar and oil because of the earnings factors to it. It's a bit of an anomalous index. It's not really, it's the mid 250s, the UK exposed index. This is a global index, really. Again, hourly basis. It's bounced off the 61.8 pullback for this, what looks like a 3-wave, potential wave 2. But this today could be a connector to further downside, but I'm not sure. Choppiness, it's another index. We look to buy wherever it is at the end of the week, really. Am I channeling all the waves? What do you mean? Mr. Rechinu? For the gold chart, I'll just go on to that live. So for gold, we talked the previous week about the. Do you chat? Yeah, you should channel them. Yeah. So the A, B, and C you're looking for. Obviously, there can be a bit of a misnomer to get used to because sometimes the A wave is 5 waves down. In which case you do a 5-3-5, or it could be 3 waves down, 3 waves up, 3 waves, and then 5 waves down. Always finishes with 5 waves in the final leg, however you look at it. But yeah, you can channel, and you probably should. But I tend to find it just as instructive to look for the equal legs as your first finishing point. That is where the majority of three-wave consolidations finish. So that's kind of your starting point. And then if they go towards 1.618, or 1.618 is an impulsive wave normally. So that could mean that it's a change of trend overall, that's going to get bigger. But it doesn't have to. You can have 200% C leg and it still be part of the consolidation. You just need to keep an eye on the overall sense of it and whether there's any divergence versus the MAC D waves and peaks, other confluences, etc. But yeah, I find it useful to channel them all, but generally, how can I say, to keep my charts uncluttered, not having it on all the time. The key with why this could go down quite quickly for the wave 4, if that's what we're into, if it has topped, is that wave 2 didn't drop very far, but it took over 3 weeks to go sideways, the red wave 2. Alternation is a thing, so that waves 2 and 4 often opposite in time and strength and shape. So if you've got a shallow sideways one, it's highly likely you get a deep, quick one. So that's why I've said that it could come down fairly quickly to get this, and that's to get it out of the way as well before events for the end of the year. And what that does, you're then looking for wave 4s of previous pullbacks, which that gives us the immediate lowest degree wave 4 we've been playing. That's 2600, and then the wave 1 and 2 from the start there. So we had all that mid-year nonsense, didn't we? Trying to find the minuet wave 4, which was in July sometime. So the bounce from that is extreme 2350, but anywhere from 2500 to 2350 for the sub-minuet level. But the actual minuet wave was down here at 2300. I think going to the absolute extremes of the waves is probably too much. Remember, it's anywhere from the top of 3 to bottom of 4. We know how long and how wide that lower degree fourth wave was there. 2300 to 2500 basically. So I'm thinking that we come back maximum to sort of 20, somewhere between 2600. So we've got questions here. If fundamentals are super important, then where's the balance between other traders saying trading needs to be as simple as possible? To me, the market is everything. It's everybody's views, fundamentalists, technicals, people who trade both. Fundamentals can be in control sometimes the technicals. I think what people try to make it super simple, that might work for how they want to trade, but in terms of total big picture and relative understanding, it's only having a part of the picture. If you want to be able to understand why what is a perfect setup broke down, then the actual fundamental backdrop to it can often fill in the gaps for why that technical structure broke down. That gives you a little bit more edge. You can have that in the back of your mind as a test point going forward. It's how much you believe. I actually believe that all information is in there. By definition, every different trading style is in there competing with each other. We're looking for the predominant fundamental and technical trend, and by technical that includes volume in a massive way. So it's just trying to find extra edge rather than just having a random walk. Like I said before, if you've got to explain yourself to a risk manager and all you're saying is you've got no reason why it's not a coin toss, then you probably get sacked if you put the trade on. Just there's no edge. Why are you gambling your money on that? They'd rather allocate the money to a situation where, due to fundamental analysis combined with some technicals, there is an edge that's suggesting 60 to 70% likelihood of that trade to take place. That is the ultimate of what people are in the game for. So more work rather than less work, I suggest, is the way forward. But if you're comfortable just doing the bare minimum, then that's your choice. But equally, don't just turn around and have a go at people and say, oh, it's obvious there's a fair value gap or an order block or whatever, or some other form of technical analysis just to poo-poo people. You can't know what is behind necessarily the strategy of the people implementing those stops and or turning volumes. So we need to try and understand what is the motivation of the buyer, who is actually sitting there mopping up the distressed seller, expecting to then put in a buy order even higher and drive the thing in the guy's face. So yeah, very absolutely, it's all about having confluences. Do you remember that guy we used to have on the on the chat? He used to draw his Kaplunk. That was crazy, wasn't it? Rashid, very good point. And there's a reason why wave 2 and 4 are the good ones to trade. It's because they are reversals. They're fairly tightly defined, and as I said, you've got a lot of instances of the equal legs being an entry zone where you know where your stop losses are, i.e. around that 1.618. If you're trading it the other way and you know you're in an impulsive sector of the market, you know it's a wave 3 and you're trying to call the top of that, then there's there's fewer instances of being able to call the top within those waves. That third wave can be split into 5 subwaves, and any of those waves can actually be sub-splitting themselves. So you're taking on impulsive waves by nature. We know that they're the ones that have the multiple fib ratios, the 1.618, 2.618, 3.618, and various other higher numbers. So there's chance for being absolutely dragged along. That's when you know you're in those wave 3s, when you're stuck in the upper or lower parts of the double Bollinger Bands that we talked about, when you're in that 1 standard deviation to 2 standard deviations. That is when the stock is beginning to impulse trade out. It's breaking trend in a big way. So yeah, trading 2 and 4 can conceptually be a lot easier. That's where you might have a higher win percentage of identifying the start of a wave 3, which if you can then have the confidence to hold will make you lots of money. But yes, it's much better. That equal legs thing is very, very powerful for timing. So it definitely wouldn't put you off trading that way. So Dami, hope that helps. I think it's all about having as many, as Vivi says, confluences, fundamental or technical, just having extra knowledge so that you can then see repeat patterns. And you can look at the chart sometimes and think there's absolutely no way that can happen unless X, Y, Z, which then makes you think, actually, no one's talking about that. That is something new, and you only need to start seeing things happen. And equally, we look at the data because the market is set up a particular way for inflation, for interest rate cuts. And if we can see something in there that is definitely not being talked about and is definitely opposite of what's going on, we've suddenly got edge. We know that we should be taking on the predominant trend. Not going to win every time, and obviously weight of money will by definition carry on. As people say, you can have the right strategy but run out of money. You can't remember the exact quote, but you can go poor before your strategy wins. But if you're picking the right strategy, by definition, if you can stay in the game long enough, which is why you use the stop losses, then you should come out ahead eventually. Right, jeepers guys, that is a long session. I imagine I'm boring you to death with all that. Anyway, gold, let's just move back across to where we were. So again, there's no reason why we can't still be extending. We've put in a 3-wave. So the current lows, obviously, We need that to break down to confirm that we're moving again. We're looking for that equal legs 2700, etc. But if you are shorting it, just be alive to the fact that it could still just be another consolidation within this extending fifth wave. The odds are getting increasingly that it has topped, but this thing has burnt us a few times. Let's just see if we can de-escalate Iran a little bit. And obviously a Harris win is less, it's still money supply negative, but less so than Trump, etc. So effectively channeling, when you're putting in the equal legs, you're picking the top of, right, we said here, looking on the gold. So we've got the top of the wave 3. So we're looking for a 5-wave move down and then a consolidation up. So we're pretty much thinking that move down there is an A wave. 3-wave consolidation to get as a B wave. So we're now expecting 5 waves down for a C wave in its simplicity. So we've had 1, a 2, so we expect a big 3 down, a 4 and a 5. So channel wise, what's the best way of looking at that? Let's get the parallel. It's a parallel channel that you want to use because they become quite powerful. So we'll start that at the top. We'll go through what we now think is the wave B and then pull it to what you think is the bottom of wave A. So that's given us a channel that we think we're going to be trading down at. Now, the fib confluence we're looking at is the 2700. So we could hold on quite tightly to the upper side of that parallel channel, just be a meandering sell-off, or we could go straight down and challenge the bottom of the trend channel, and we'd expect that to be probably an overthrow to around where the white blob is really, come back in, and then ultimately the final sell-off that probably to be super clean to hold somewhere in here, which again, that's breaking 2700, bottom of the trend line, and I'd be expecting to start thinking about at least a connector, at least a 3-wave up from that point to have another go at 2700. And then again, we'll find out with the relationship of the waves, is that going to be a 1 spot 618 in its third leg? Then we're starting to think about, are we into the fifth wave up, or is it just doing a 3-wave connector that ultimately goes down, and then we'll be looking at the double of this first 3-wave move. We'll adjust the trend channel. That'll now become A. The consolidator would be the B top, and that would probably change its gradient and make it steeper as a result. Does that help? So that, by definition, gives us some support and resistance in that proprietary channel to expect to maybe get some short-term, very short-term reversal trades if you want to do them. Excellent. What else have I got left? Yeah, so I've got one more chart in that thing that I saw. I'm just fed up of hearing the same rubbish, so I thought I had to bring it up. So I've forgotten who this is. I think it looks like another Bank of America, looking at the fonts they're using. It might even be Goldman's. And they're trying to say that the reason why gold has gone through the roof is that the inversion of the US 10-year yield has made is giving you a direct correlation of what's going on. So yes, that's always been the case. It kind of is, but it's missing completely what we talked about. The real issue from Russia central bank assets was de-dollarization, not de-dollarization in terms of money supply explosion and fiat money, etc. Yeah, that's there and obviously a big factor. But this completely changed the game. And it also happened right in the middle of the reserve asset status changing. So that opened up the door to big gold holders, knowing that they have to own 85% of it. So it creates a massive physical demand and price pressure on the very one asset they're trying to buy that they want to go up to help make them solvent. And that is the real driver of gold. We know it, 85%. Everyone's still taking the gold home. India took another 100 tons home from somewhere yesterday. It's all about repatriation. Own it. Don't let anyone else have it. You need it physically. You have to have it physically under your control. That is just as much as the old school real yields argument. That is kind of implicit within what's happening to the dollar. Even though the absolute dollar level hasn't collapsed, the relative purchasing power, etc., has. Monetary debasing. But it's literally the massive driver this year. Central banks are back up to about 12% of reserve assets in gold. Historically, when there was a gold standard or it had any importance, it was 30 to 40. So we're only a quarter of the way through the demand side move of gold. That's what the mainstream should be telling you, instead of forever trying to make up a reason why not to hold it. Off my soapbox. Oil, again, very last thing. I keep saying that is nesting ones and twos, keeps having a bounce. The real invalidation level is back up here, 82, 81 and a half. We can have extended rallies anywhere within this, but still have a downward bias. So, as I say, keep looking to fade it, play the geopolitics. If you can capture a feel, like I said, that there is going to be an escalation of geopolitics, then that's when it looks like a buy. But you're fighting what I think is the downward trend, and at some point into next year, that's the danger for the markets. The stimulus hasn't worked, and we do slow down, in which case oil is a massive downside asset to play, because that'll go into the 40s. Right, that is the end. Is there any more questions? I hope that's been useful. Yes, Vishnu, this year there were a lot of events that then held that. You had the geopolitical angle too, but I'd say it was a perfect storm for people involved on that side of things, particularly the BRICS. They got every incentive to make gold go up and to use the new rules. And that is why the correlation with the dollar and interest rates hasn't always been as solid as it can be. We know we've proved before that it isn't a negative 1 for 1, and the dollar certainly. But we've got, we've showed it at the right points. There is huge amounts of physical demand that can suddenly make this paper market look like the casino everyone says it is. So back on the bike, Mr. Vishnu. Let's have those profits back, and I'll speak to you all on my chat. I might be doing something on Wednesday. I'll let you know, which will be looking at some of that Atlanta now in more detail that we talked about. Anyway, good luck. Speak to you soon. Bye.